feel at this juncture, investors should adopt a more constructive view on Indian equities. Why? Let me give you a few reasons I picked from an engagement with a renowned fund manager. The first point, FPI selling peaked in March when foreign investors sold a record $13 billion of Indian equities in a single month. Since the announcement of the US-Iran peace deal in June, FIs have turned net buyers with a net inflow of about $1.2 billion in the second half of June. The second point is, after a volatile start to the year, Brent crude is now trading at about $70 per barrel. This is the below pre-war levels. The current account deficit impact from the temporary oil price spike is marginal. Oil supply is likely to outpace demand once the market recovers from the Strait of Hormuz disruption. In 2027, International Energy Agency expects global oil demand to increase by only 2 MBPD to about 105 MBPD, in comparison with the supply, which is expected to rise by 8 MBPD to 110 MBPD. Now, in the medium term, given the forthcoming transition towards electric vehicles globally, this fund manager feels that this could prove to be the last major oil price spike. The third point is, and this is most important, the RBI acted decisively last month. The RBI and the government announced measures to strengthen foreign exchange reserves and restore market confidence. The implementation of FCNR and ECB measures is expected to lead an inflow of about $70 to $100 billion over the next 3 to 6 months. After a weak start, the monsoon in India has sharply revived, recording a 11% surplus over the first 6 days of July. Nevertheless, the impact of monsoon deficit, if any, would be marginal on the economy, as its dependence on monsoon has reduced meaningfully. The fifth point is global capital allocation is currently dominated by AI boom or AI mania, with the AI related subsectors accounting for 70% of the global market gains year to date, and even narrower concentration than the peak at the dot-com era in early 2000, when beneficiary sectors contributed 60% of market gains. Now, this year, markets such as US, South Korea, Taiwan, Japan are benefiting from a massive liquidity-driven AI investment cycle, particularly in data centers, semiconductors, and advanced infrastructure. India has limited exposure to these themes and has effectively become a funding source for global investors. As with technology revolutions in the past, the AI boom will eventually mature and its outsized gains will normalize. When global markets mean revert, India will be well positioned in our view to see a significant recovery in FPI flows. The sixth point is, with the RBI forecasting about a 6.5% real GDP growth and a 5% CPI inflation in FY27, nominal GDP growth should remain in double digits. However, the consensus Nifty EPS forecasts imply that only 4% growth in FY27. So there is a lot of room for upgrades in this, in his view. The seventh point is the 2 years of time consolidation or the time correction at a modest price correction have materially improved the market's risk reward. The Nifty's 1 year forward PE multiples of 18.5 times is 15% below its recent peak and broadly in line with its 10-year average. India's premium to emerging markets have also normalized to about 74%, broadly in line with its 10-year average. So to conclude, the case for Indian equities has now strengthened. The economy, earnings and markets have shown resilience in the face of adversity. Valuations including premium over emerging markets have normalized, and equity ownership has shifted into stronger hands, that is, Indian investors. So with the macro environment now turning and earnings momentum intact, we are constructive on future returns. Thank you.